welcome on board Kenneth Andrade, founder and CIO at Old Bridge Capital Management, and ask him what he's making of the markets. Kenneth, hi, morning. Great to have you on the show. Kenneth, 1 month into the new year and it already feels like a century. So much has happened. What should the Indian investor be keeping in mind, and what is it that they should be erasing from their memory?
I think 2026 is another year of consolidation. You had 24, 25, and 26 out there. And as far as the Indian investor goes, I think the start of this year has been a great sentiment booster, especially what's happened transition over the last couple of days. It's a huge sentiment booster. It's also extremely good in the long term. We finally got our realignment in trade happening with two of the largest economies of the world, which is the European Union and the US. But one thing that just dogs the market continues to be valuations are fair. They're not extremely cheap, and we'll have to wait and see if earnings catch momentum. Our sense is that earnings will still be around that low double-digit number, but we'll see how as the year progresses. So net, a little more patience for 2026, and then things should be relatively okay. 2027, we should start off with a reasonably okay valuation benchmark, and from there we can take it forward.
But Kenneth, at the crux of it all, I guess, would be earnings, and then, of course, the overall derivative valuation that the market ascribes to those companies. When is it that you are bound to see or will see a meaningful earnings revival beyond consumption?
So let me put it a little differently. I mean, the underlying economy lacked capex or significant capex out there. There were also a reasonable amount of headwinds as far as where demand would come from. So if you track Indian corporate earnings that were there, they were running at single-digit levels for the last probably 2.5 years. Okay, this is not indicative of a great economy or a great corporate cycle. And during that period of time, I think we've gotten our act together and using capex actually kickstart on the ground. Not significant compared to where we've been, but now we've seen demand visibility which is out there. We've seen corporates and companies that have re-established or put together some historical capex that was ongoing on the ground. What's absent out here completely is the want of demand. Is basically the demand side of the equation. So I would think with some of the global trade opportunities that have kickstarted itself, 2027 is the first year that you'll see that happen. And you will nudge your earnings up, and not just from the financials that are there, but from the rest of the economy. So 2027, the first half of 2028 financial year is when you should see something like that happen. And if you're right on that count, then I think the rest of the decade should be pretty much okay for the Indian markets and economy. On that count, I think the phase that we are in is where market caps are actually catching up to earnings and not the other way around, which we had for the better part of this decade. Right. So through this cycle, you'll see earnings consolidate itself, markets consolidate itself, incremental amount of capex happening, and we could see demand revival happening from across the world, and the Indian companies will react to that.
Kenneth, of course, we're expected to see a decent earnings upcycle come through. How are you viewing that upcycle? Can it surprise on the upside, if at all you have a view there? And where and which pockets will the earnings surprise the most in? And where have valuations not run up commensurate to the likely earnings which are expected to flow through, in your opinion?
I don't think you'll ever be surprised with corporate India's earnings. We're a much larger economy than we've been in the past. Right? And everything needs to be looked at it incrementally. But there are pockets around the marketplace where valuations are pretty much okay. I think valuations in the financials right now are pretty much benign. Technology is also pretty much okay, but then you're running the risk of lower terminal values of some of these businesses with all the technologies, with all the automation taking place. Automotive, I think the long-term structural growth is set into these businesses, but they are a tad expensive. But still, that's an opportunity that's sitting out there. In capex, I think you're taking a breather. Now, when I say capex, I'm taking manufacturing in a couple of segments and sectors of the market. Which okay, you're taking a breather out there, and some of these names are I mean, have reacted fairly positive over the last couple of years. I think that you'll take a breather for all of 26 and maybe some part of 27. So it's a very mixed bag out there. Market's been struggling to look for opportunities. We've been struggling to look for opportunities. But there are ideations at individual level which is now coming into play. So rather than look at the market in 2026 and 2027 from a macro standpoint, because there's a lot of noise on the macro side, and it sometimes camouflages what you should be really looking for. You should really be looking for individual businesses. So that's where we think 2026 and 27 will be. Look for individual outliers out there in their specific industries because they will do well. Look for companies that finishes their capex cycle because now that you're sitting with all your costs on your balance sheet, you got to invest in creating demand or through the sales force. And there are enough quantum of companies and businesses which are available in if you go looking for it. If you look at if you look at the macros and try to trade the macros, I'm not too sure you're going to make too much money in the next couple of years.
And Kenneth, also curious to know, obviously the hot topic this week is IT and the impact of AI on the IT sector, at large. Your view with regard to this?
Well, in short, the terminal value of these businesses come down, right? So maybe you have to readjust all of that with what's happening in the way you perceive this industry. So they've been trading at a certain valuation. I don't think they're going to go up significantly from here. It's already been a fairly mature business, and I think services as an industry will continue to grow, but I don't know how the market is going to price them incrementally. Valuations in this entire space have to trade downwards. It can't be where it is. Okay, today they trade at close to about 3.5 to 4% cash flow stroke dividend yield. So as long as that cash flow dividends are there, they will maintain this number. But over the longer term, I would ascribe slightly lower valuations to this entire sector.
Right. Okay. Kenneth, so good having you on the show. Thank you as always for your time.
Super. Thank you very much.